So if you felt your wallet getting a little bit lighter this past month, well, you're definitely not alone. A major global conflict has just sent a huge shockwave through the economy, and we're just now seeing the first numbers that show its real impact on our cost of living. So let's get right into it and break down what's going on.
The big headline number for March 2026 inflation just dropped, and it is 3.3%. Now, that number by itself might not sound like a huge deal, but believe me, it's how fast we got here that's setting off all the alarm bells.
I mean, just look at this jump. Only last month, we were sitting at a much more manageable 2.4%. To leap from 2.4 to 3.3 in just 1 month, well, that's not a gradual trend. That's a jolt to the system, and it's telling us something big has changed.
So what's actually driving this? This March report is really our first look at the economic fallout from the new conflict that kicked off right at the end of February.
And to really get what's going on with these prices, you have to trace it back to the source. And that source is a sudden, pretty severe shock to the world's supply of oil.
Here's the timeline of how it all went down. The war started on February 28th. Then, almost right away in early March, a critical shipping lane, the Strait of Hormuz, was blockaded. And the result? By the end of the month, the price of oil had just exploded, going from around $70 a barrel all the way up to $118.
And why is this one spot such a massive deal? Because the Strait of Hormuz isn't just some random waterway. We're talking about the transit point for about a fifth of the entire planet's oil supply. Shutting that down is like clamping a major artery of the global economy. It's a huge problem.
Okay, so a conflict halfway around the world makes oil prices go crazy. But how does that actually turn into the higher prices that you and I are paying every day? Let's follow the chain reaction. This chart really tells the story. You can see the overall cost of energy shot up a massive 12.5%. But look what happens when you take out the really volatile stuff, food and energy, which is what economists call core inflation. Everything else only went up a much more modest 2.6%. It's pretty obvious who the main culprit is here.
So let's drill down a little deeper into that energy number. Where exactly did it hurt the most? Well, no surprise here, it's at the gas station and at the airport. Gasoline prices are up an absolutely staggering 18.9%, and airline fares jumped 14.9%. These are the direct, right-in-your-face consequences of that oil shock.
And what does an 18.9% jump at the pump feel like in the real world? It feels like this: $4.12. That is the new national average for a gallon of gas. If you're getting some painful flashbacks to 2022 right now, you are not alone.
But the pain doesn't just stop at the pump. This is where things start to, well, leak into other parts of the economy. We're already seeing it. The price of food away from home is up 3.8% because it costs more to truck the food to restaurants. E-commerce sites are starting to add new fuel surcharges. You see, the ripples are really just getting started. And if you're hoping this is all just a temporary blip, well, the experts are pretty worried. Mark Zandi, he's the chief economist at Moody's, put it about as bluntly as you can. Inflation is a problem, and it's only going to get worse. That suggests we're really just at the beginning of feeling these price pressures.
So this sudden spike in inflation puts one group in a really, really tough spot: the U.S. Federal Reserve, the institution whose whole job is to keep prices stable.
And now they've got this massive dilemma. The plan all along was to start cutting interest rates. But now, with inflation taking off again, do they have to completely reverse course and raise rates to fight it? It's a high-stakes decision for the entire economy, either way they go. And remember, the Fed's target, their sweet spot for inflation, is 2%. At 3.3% and climbing, we are way off target. That's why you're hearing them use words like nimble, which is basically central bank code for, yeah, all our old plans might just go out the window.
So, with all of this disruption and all this uncertainty, the biggest question on everyone's mind is, what happens next? Well, even in the best-case scenario, where the conflict ends tomorrow, don't expect prices to drop overnight. Joe Seidel from JP Morgan has this perfect metaphor for it. He says prices are often up like a rocket and down like a feather, meaning they shoot up in a crisis, but they take forever to drift back down.
And there's another reason prices might not fall all the way back down. It's something economists call a risk premium. Basically, the global market is now pricing in the fear that this kind of disruption could happen again. And that fear, all by itself, can keep prices higher long after the actual crisis is over. Which leaves us with one last, pretty big question to think about. We've just watched prices shoot up like a rocket.
But if they only drift back down like a feather and some of those higher costs never fully go away, what becomes our new normal?